So MPW, Medical Properties Trust, they're going to report earnings on November 7th, third quarter earnings. And this company has really been struggling. The stock is down like 80 or 90% since January 2022. Let me pull up Yahoo Finance. I know this is a pretty popular stock because any stock that pays a high dividend gets a lot of attention. So you got to really look beneath the hood, which is, easier said than done. I get that. Let me go to Simply Wall Street. Yahoo Finance has been a little slow lately. MPW is a ticker. So it really started to take a dive in 2022. I think that was its peak in January 2022. Pretty close to its peak. I think right before COVID, it hit $24, $23.94, which was its actual peak. It came down and now it went back up. So January 2022, it got back up to its all-time high, and ever since that point, the stock has come down a lot. So it was $23.45. So that was like the peak in January 2022. And now it's $4.51. So it fell 81%. So a little less than 3 years, it's down 81%. And the main reason is because of Steward, Steward. That's their biggest tenant. And they filed bankruptcy this year. I think 17% of their assets are with Steward Healthcare. So, like, if you look at Steward's Wikipedia page, it talks about the bankruptcy. They filed bankruptcy in May 2024. And you wonder, why it started going down. Because in 2022, it reached its peak, right? In January 2022. So you wonder, why did it start going down then? Like, if it wasn't until May 2024, Steward announced bankruptcy, like, how did people know? Why was this big sell-off preceding the bankruptcy? Well, it's kind of, it's obvious in a way, because their revenue was going down, and they did mention in their quarterly filings, even in 2022 and 2023, that they're not receiving as much, and they had to give a discount to Steward because they couldn't afford their rent payments. And if you look at this company's look at funds from operations. If you follow a REIT, if you invest in REITs or follow REITs, you probably are familiar with FFO, funds from operations. I'll just so FFO is net income plus depreciation and amortization minus the gain on sale of real estate. It's a non-GAAP item, so it's not required. If you're a REIT, you don't have to report FFO. Like the SEC will not ding you if you don't report it. But if you invest in REITs, it's kind of expected that you're going to show FFO. So their FFO, there's similarities between FFO and free cash flow and EBITDA. A lot of similarities. But anyways, their FFO for the second quarter of 2024, this is the latest financials. They're reporting next week on November 7th, was 140, was actually, no, that's normalized FFO. I would ignore that. Their FFO is negative 90 million. So they bled 90 million of cash. Where if you look at the second quarter of 2023, it's 340 million. So you would expect a REIT to have positive, well, you'd expect any company to have cash flow. If they don't, then you probably want to avoid. But a REIT generally has low overhead. They pretty much have no overhead. They don't even have that many employees. They buy real estate or develop real estate, and then they rent it out. So there's not too much risk being a REIT. That's why they pay such nice dividends. But the reason their funds from operations was negative 90 million in the second quarter was they had a net loss of 320 million for the quarter. And you'd have to kind of go. They do show normalized FFO, which is it's like the difference between EBITDA versus adjusted EBITDA. Anytime you see the word adjusted, when you see adjusted net income, adjusted earnings, I wouldn't totally ignore it, but take it with a grain of salt, because the reason they're adjusting it is to make it look better. So when they report the numbers, they can tell everyone our adjusted net income is 5 billion when our actual net income is 2 billion. It just makes things look better. So the reason they had such a big loss in second quarter was the bankruptcy of Stewart. I'll show you their income statement. This is not their 10Q. This is their presentation slides, but it shows all their financials. So this is their income statement for the second quarter. Revenue, which is mostly rent, they charge their tenants. And that went down a lot. It was 337 million in the second quarter of 23. It's down to 266 million. So rent went down a lot. Expenses also went down a lot, which is good. But right here is a loss from equity interests, 401 million. They also took a big impairment, an asset impairment. That's when you write down the value of an asset. They write down the value of the real estate. So this 401 million is really the reason they had this net loss of 325 million. If it wasn't for that, they would be profitable. And then you could trace this 401 million. This is their balance sheet. Okay, so sometimes you have to dig a little deeper. Just reading the income statement isn't always enough. Sometimes you have to read the additional statements. So this is called investments in unconsolidated real estate joint ventures. So this is their investments in other companies. And right here, it shows. Okay, so this bottom half, it shows their equity interest. So they had revenue from the companies they're invested in, 31 million. Net income, expense of 27 million, net income of 4 million. So it's kind of insignificant, the profits they generate from their investments in other companies relative to the whole business. It's pretty minute. So you can kind of ignore it. It's 31 million is not much. But right here, Steward Healthcare joint venture impairment, negative 411 million. So that's the reason they had a big loss in the second quarter. And they footnote it right here, D. In the second quarter, we fully impaired. Let me blow up this statement so it's easy to read. So in the second quarter of 2024, we fully impaired our Steward Healthcare joint venture investment. During the second quarter of 2024, a total of 28 million of rent, 14 million was their share, so half of it was paid to this joint venture. I don't know how they get to 28 million, but there's 27 million here. So this is so they just wrote down the value of their investment in Steward. So they expect to receive $400 million of rent payments, I guess, over a certain amount of time, maybe a few years, and they're totally taking a loss on that. That's what happens when a company enters bankruptcy. You really got to dig into the stuff because they won't explain this outright. Like when a company is really profitable or revenue is up, they'll explain that crystal clear. They'll say the reason revenue increase was from our data centers, or they'll explain it crystal clear so you understand exactly what that is. But when it's not good news, they're not going to really highlight it and explain it. It'll be kind of hidden in this information. So they say they have 1.8 billion of investment in Steward. Now, I read this before too. Now I'm learning more because I guess I didn't read everything. I just did a video. Let's see what else it says about Steward. Well, it does mention as Steward is currently going through the bankruptcy and re-tenanting process, the amounts shown above represent what is contractually owed per the lease/loan agreements. Okay, here's the 20 million for Steward. Okay, so this is clear now. These kind of things don't come up too often. So it's not like if you get real comfortable reading the income statement, like you're familiar with how revenue works, how expenses work, then you can look at it like another company's income statement and understand it. Maybe there'll be one extra thing on the income statement you're not familiar with, so you Google that term. But this doesn't happen too often, where a company goes bankrupt and they have to then take a loss on their investment, but they're still kind of renegotiating terms with them. So total assets for Steward is 2.9 billion. I'm just running this down. It'll help me memorize it quicker. So Q2 rev And this is by far the biggest tenant, so it's a big deal when your biggest tenant goes bankrupt. And leave a comment. So total, okay, for the second quarter, revenue was 20 million. I'd like to go back because if you look at Circle Health has 36 properties with this REIT. So this particular REIT has 435 properties, Medical Properties Trust, the REIT structure. It has 435 properties, 36 are with Steward, 36 with Circle Health. So they both have the same number of properties, but the revenue for Circle is 50 million for the quarter. Revenue is the rent they received. The rent Medical Properties Trust received from its tenant Circle Health from their 36 properties. But Steward has the same number of properties with 20 million of revenue. So obviously they're giving them a discount because they're bankrupt. They can't afford. So let's go back to that. Investments in unconsolidated joint ventures. So this here, like this top portion, I guess everything above the 4.3 million on this page is all their joint ventures. It even talks about the joint venture that they're invested in. Median, that's the name of the company. Swiss Medical Network, that's another company they're invested in. It looks like, I guess, an Italian company. HM Hospitals. So those are the 4 joint ventures they're invested in. And this is the revenue they receive from those 4 joint ventures. So this 411 million is not connected with these joint ventures. This 411 million is exclusively connected with Steward. I mean, I find this stuff really interesting because I'm learning something new. I don't really ever get the opportunity to dig in to this level on this particular topic. This is where you learn a lot too. Okay. So for these 4 joint ventures, this is the balance sheet for the 4 joint ventures. 2.1 billion of assets, 2.1 billion of liabilities. They also have Common Spirit joint venture, that's 106 million. But they don't have the details, so they didn't break it down up here. And then you have the revenue from these joint ventures, which is 31 million. Then expenses of 27 million. So their profit from these investments is 4.3 million. But when you have unconsolidated investments, the revenue and the expenses are not included on your income statement. Only if it's consolidated. If it's unconsolidated, then you just report. I'll show you. So they're just reporting the it's in other income and expenses is where they report the profits or losses from their equity investments. I'd like to look at last quarter to see. So they took. So in the second quarter, we fully impaired their JV in Steward. So this indicates it's a total write-down. But it's a $410 million impairment. The assets for Steward is 2.9 billion. So that's why I'm not quite clear. I would expect the impairment to be 2.9 billion. Unless well, we don't have the detail, but I guess the assets are 2.9 billion, and I would imagine like the debt on Stewart is 2.5 billion. So assets minus the debt is 400 million. That's why they wrote down 400 million and not 2.9 billion. This is pretty interesting. And the reason I try to do this, even though it's after the fact, because if I could understand this, maybe I could identify it next time before it happens, and then I could short the stock or buy the stock depending on the situation. Let me see. I'm going to go to I want to see prior investor relations reports for Medical Properties Trust. I'm curious if they took a write down in the past as well. They did an update on Stewart in October. I didn't look at this. So this is just Stewart. 34 facilities, 6 million beds. The investment is 3.3 billion. Really high yield. Okay, so Stewart is an operator. Last half, my first comment. What's up? Okay, so now it makes sense. Stewart is one of the operators within the REIT. And as we know, there's many operators. So Stewart is the biggest operator. They operate long-term care facilities. They operate emergency rooms. The second biggest is Priority Group, then Median, Ernest Health, etc. So there's a lot of operators that this REIT funded. But in addition to being an operator, Medical Properties Trust also invested in Stewart. Like they didn't invest in all these operators. Well, they invested in Median because we saw it in the list below, but not all the operators they're invested in. So Median, so you can see Median is one of their unconsolidated joint ventures. So Swiss, let's read that footnote on Median. So if you go to Stewart and you go to their Wikipedia page and you could see who owns the company, and Stewart Physicians. So I guess it's mostly owned by the physicians that work at the company, but you can see Medical Properties Trust owns 10% of this company. So the 10%, that joint venture investment is what got written down and why the stock is cratering. So MPT Stewart Investments, Wadley and Norwood projects. So that's 7% of their investment in these projects. $90 million invested to date on construction and progress at Wadley. So these are they're developing facilities currently. I actually work. I'm a controller at a real estate developing company, real estate developer, and so we have multiple properties going on where we're developing the land, putting the structure in, and then we're going to get tenants in there and start renting out to those tenants. We actually have some rented out currently. Steward Health had a number of facilities in my area. Can they recover from that? Yeah, I think they can. I think they can. It's going to be a long road. But let me just to clarify. So when you hear a company file bankruptcy, most people think the company's gone, like they're out of business. So if they file Chapter 7, then that's considered liquidation, where they're selling their assets, liquidating everything. So let's say a company filed Chapter 7, and they had assets of $5 million. And they had debt of $10 million. Generally, companies that go bankrupt have more debt than assets. So they would just sell their assets. I'm not going to use this company, but I think it's more straightforward if it was a normal company, not a REIT. So let's say that these are their assets. They have cash of $1 million. Inventory of $2 million. This is kind of a simplified way of what happens in the bankruptcy process. So if a company files Chapter 7, then now a bankruptcy judge steps in and kind of helps the process. So if you're even getting close to filing bankruptcy, you probably have a lot of people calling you all the time. You're past due. When are you going to pay? Some people will get upset with you, yell at you, because some people sold you something. Another business sold you something. It might be a small business, and they might not have that much money themselves. You might get threatening letters. But I have a big position in MPT. What's your cost basis? Like, how much did you invest? Like, the share price when you bought it. Is it over $10, or is it under 10? So a bankruptcy, a lawyer would step in and help you in a bankruptcy process. You're kind of shielded from investors. They can't bother you anymore, in a sense. They have to go through the bankruptcy court. So if this was your balance sheet, this is the value of your assets, then say the bankruptcy judge or lawyer who assists you, the cash stays the cash. So that $1 million in cash will not change. But you'll see on these other assets how just because you wrote $1 million of real estate doesn't mean you can get $1 million for that building. Say you have a building that you value at $1 million, but just because you value it doesn't mean you could get somebody to give you that $1 million to buy it, especially if you need to sell it in a short amount of time. Like if you had a year to sell your home, or as long as you needed, you could just wait to get the right price. But if it's a fire sale and all your creditors, the people that you owe $10 million to, are, getting upset, threatening to sue, you got to kind of get cash as quick as possible. So that real estate, even though it's $1 million, you might only get $700,000 for it, because you're not going to be shopping around. You're pretty much going to look for the first deal. And then accounts receivables, this is how much money your customers owe you. So this is an asset to you, but generally you're not going to get the full $1 million, even though you're owed that, because maybe one of the companies you sold to is going bankrupt themselves. So maybe you'll take a 20% discount on that. So you get $800K from your receivables. Inventory is your biggest asset, but as you can imagine, just because you have $2 million of inventory doesn't mean you're going to get $2 million for it. You might get lucky and find one of your competitors who is willing to give you $1.5 million for your inventory. So even though you had $5 million of assets according to your balance sheet, 509. That's not bad. That's not bad at all. I wouldn't average down. I wouldn't touch it. That's just me. I would, if you want to let it ride, that's fine. But it could be a long time. The thing with these, if you want to be a bottom feeder and try to pick up stocks at a discount, if you get lucky and there's really positive news about a stock, it could go in one day, it could go to 5 to 15 in one day, because there's this big story about how this company is going to come and acquire Medical Properties Trust, and all these positive things come out, but that doesn't go through. Medical Properties Trust thought they had a buyer for all their facilities, but that buyer backed out. So maybe in a few days, the stock goes up a ton, but then it'll come back down eventually, unless, of course, the positive news is actually true and actually happens. So that could happen. That's why some people pick up really cheap stocks, hoping for some positive news where the stock jumps, and then they sell it as soon as that happens. So you might want to put a sell order in just in case. So anyways, the bankruptcy court is able to get $4 million from your assets. So they give it to the people who you're indebted to. So after giving them $4 million, then now you have $6 million of debt, and you just close the business. And the people you're owed money to have to eat it. That's just, they can't really do anything at that point. If the company's gone, they can't go after you personally, assuming you have a LLC or corporation, which if you're a public company, you definitely do. If you're a sole proprietor, they could go after your personal assets. But I'm assuming it's a regular company. So once the bankruptcy process is complete, I'm talking about Chapter 7 now, then it's done. Everybody walks away, and you can start another business. You could work for somebody. You can jump off a bridge. You can, or whatever you want. So Chapter 7 is, in a sense, the end. It's just a matter of time. So you probably don't want to invest in Chapter 7 company unless, I actually made a lot of money Bear Stearns in 2007, the Great Recession. They filed bankruptcy, and the stock went to like $2. So I bought a lot of shares, and then I got lucky, kind of. And then a week or two later, J.P. Morgan said, "We'll buy the entire company, and we'll give $5 per share." So I more than doubled my investment. But for a long-term thing, you're probably not going to make. You're probably going to lose all your money if you invest in Chapter 7 company. If recovery is possible, are any of their other tenants in the same condition? How did the management not catch the problem? No, well, they knew it. Like, management was mentioned, Stewart, in prior reports. Investor, people knew about it, especially the those analysts who rate the stock. They knew about it. Because the stock in January 2022 was pretty much at its peak, $24. That was its highest point ever. And you see it's going down pretty much every single quarter. And at this point, in May 2024 is when Stewart filed bankruptcy. So Stewart didn't. So it was going down. It was already down like 60, 70% before Stewart filed bankruptcy. If can get close to even watch from the sidelines. If recovery. So they were mentioning in their reports to shareholders in 2022 and 2023 that Stewart is missed a lease payment. So they were mentioning things like that in their report. So that's why the stock was going down. The writing was on the wall. I'm trying to find it. This is so this report was written in August 2022. So well before the bankruptcy, 2 years before. And they mentioned Stewart operations have improved a lot ahead of fourth quarter. So they were mentioning it in the reports that Stewart missed a rent payment, or they had to give Stewart a discount on rent. Because if you have a tenant, like if you own an apartment building with 4 units, so if you own an apartment building with 4 units, so you get $6,000 of rent per month. And let's just say you have like a mortgage on a property, and of course you have this other expenses, but you're maintaining the units yourself. So you don't have as much expenses. You don't need a handyman, things like that. So let's say your expenses, all in, the mortgage, the interest, you may have HOA fees, maybe there's other miscellaneous expenses. It's roughly like if you spread the expenses across the units, is about $1,000 a unit. So you you're making roughly $2,000 a month on average. Some months you don't make anything because maybe one month there was a big expense. Like you pay property taxes usually once or twice a year. So let's say everything is going fine, but 1 month, one of your tenants loses their job and misses rent. So let's say it's in unit 4, they don't pay anything. And they're like, I'm sorry, I lost my job. I'm really struggling. We got to feed the kids. But you're still profitable. You still made $500 that month because it cost you roughly $4,000. So even though you want to get rid of them and you want to find someone that can pay, it's a long process. You got to find somebody, then you have to kick them out. So maybe instead of this is how they do it with their tenants. So maybe you say to them, listen, I got to get some rent because I have expenses myself. So I'll give you a deal. Instead of $1,500, I'll just give you 6 months at $750. And maybe you write a contract and say after 6 months, if you can't pay your rent, if you can't pay the full 15, starting month 7, you have to leave. You can't stay here. You can't try to be a squatter and make me. And they agree to that, and they're really happy with that because it's not ideal, but at least you're making money still. You made money even if they didn't pay rent, but. So that's how these companies do it. They have to renegotiate because they don't want. It's a headache when people leave the property. But so they do mention like in the reports how Stewart is struggling, and so it wasn't totally in the dark. That's why the stock was already down as much as it could go down. Well before the bankruptcy, because the bankruptcy was here, I think in May. So it was already down pretty much to its lowest point. That's why you can't wait for like a company to file bankruptcy. You have to like try to understand that they're getting close to bankruptcy. And if you want to short a stock, you got to do it like over here. You can't wait till the last minute. But yeah, I'm curious to look into prior. Let's look at April. And they're going to say positive things if they can. They say MPT investment in Stewart Hospitals has been highly successful. $4.5 billion investments in properties initially operated by Stewart. So maybe this is before the things got bad with Stewart. But I know in reports, because MPT so their peak in revenue, Medical Properties Trust, was 1.6 billion. That was their peak. And their revenue is going down each quarter. Look at it. It was down to 1.4 billion in September 2023. Then it took another dive. So when revenue is going down, people knew something was up. So they can't just say, MPT can't just say rent is down. That's just life. They have to explain it a little bit. So they did mention Stewart missed a rent payment, or we gave them a deal where they can pay a lower rent. So it was leading up to that point, because most companies are increasing revenue the past 2 years with inflation, not going down. I mean, in a sense, they ignored it, but they were hoping for the best. Just like if you have a tenant like in my scenario, let's do another extreme. Let's do a different scenario. This is more like steward. Say we'll keep unit 4 is like the steward in your apartment building, but this is more like it. So say the first 3 tenants pay $1,000 each, but the 4th unit is a really nice unit. Maybe it's on the top floor. It's more like a penthouse. And that tenant pays $3,000 a month. Okay. And let's say the same thing. Your expenses, if you spread out your expenses over 4 units, we don't have to even spread it out. Let's just say your monthly expenses are $4,000. And the 3 tenants paying $1,000 each are fine. But the tenant that pays $3,000 didn't pay any rent 1 month. So now you lost $1,000 because you have $4,000 of monthly expenses. You only got $3,000 of rent. So it's painful, this tenant not paying. So you obviously you want them to pay, but you're too scared to kick them out because it could take a few months. I did that once in New York. I had to kick a tenant out. It's 6 months of no rent. Plus, I had to pay a lawyer $1,500 because it takes like 2 or 3 months to get them out, and then another 2 or 3 months you have to clean up the place and then find a new tenant. And you might not be able to afford to get 6 months of no rent on this unit. So you try to get them to give you partial payment. Maybe, like I said, maybe you go, okay, I'll do half price. And half price, you're making a small profit. But it's painful. It's hard to, and a lot of people say, I say that all the time to friends, like friends who have rentals, and they complain, oh, they still didn't pay. I say, you just got to kick them out because they're never going to pay. It's always going to be the same story. They're going to miss rent here, give you less. So the stock was coming down well before the steward bankruptcy. I wish they have more, but this is good to look back, even though people think, who cares about the past? I want to learn about what stocks to invest in the future. But this is how without understanding the past, it gets hard to figure out the future. Okay, so this is good. So when did it start? So maybe at the end of 2023 is when, so let's look at this. 4th quarter of 2023. So adjusted for billing rent, straight line interest related to steward, adjusted net debt. Reflects actual revenue on consolidated. Okay, so footnote B, they say footnote B is actual revenue except for $459 million of reserves of billed rent. Okay, $336 million Q4 revenue. Let's look at their income statement. What did they report on their income statement? Okay, so it's right here. They did, you see, they did show a loss in December 2023. They showed $166 million loss on rent. So they're already passing through losses well before Stewart filed. Because sometimes I look at income statements and a company has negative revenue. And I'm like, how does that happen? Like, I know, I understand, I kind of understand how it could happen, but it's good to, here's a real example of why a company has negative revenue. Because that's like the only number that should not be negative, right? Like you can have negative net income, you can have negative cash flow, but how do you have negative revenue? That's like, say your customer comes in to buy something in your store. Instead of them giving you cash, you give them cash. Like it doesn't make sense, right? But this is they took a loss on Stewart's rent. They passed through a loss onto the income statement. Because they didn't actually lose any rent. They're not getting any rent from Stewart. So Stewart has a contract in place. That's like the same thing in your situation. Your revenue is the rent. So this is a good example. So your revenue in January was $6,000, and we'll say February was $6,000. March it was $3,000 because they didn't pay you, right? So we'll pretend for a whole year you have a contract with all your tenants. Unit 1, you have a contract. They're going to pay you $12,000 for the year each month. Unit 4, they're going to pay you $36,000 for the whole year, 3,000 times 12. So you already took a hit in March and April. They didn't pay anything. So this is how you get a negative revenue. So in May, you expect 3,000, right? But instead you write it off. You pass through a loss for the rest of the year. So for this tenant in Unit 4, their rent for the rest of the year, you're taking a loss right now. So May through December is 8 months. So you pass through a loss for the entire year. So you have negative net income for May, a negative revenue, negative 21,000. And if somebody asks you, how is that possible? You say, well, I'm not going to get any rent for the rest of the year from this unit. So I'm taking the loss right now in this month. So you don't have to take it in future months. Some companies actually like to take big losses because they get it out of the way, and then they could start reporting profits going forward. So in future months, it'll look good. Your financials will look good in future months because you won't have this loss every single month dragging you down. Does that make sense? I mean, it makes sense to me, but I don't know if it. So See, I totally missed this. Like when I looked at their financials, it didn't really register why the company was doing so poorly. Okay. So I'll show you on one screen. So, and this helps me too to understand it better. Okay, so this is their income statement right here. And you see in December 2022, the fourth quarter of 2022, they had a revenue of 380 million. That was a normal quarter. They received 231 million of rent. They charge all the facilities, the ERs, the acute healthcare facilities, the 400 facilities that they rent out. They charge those people rent. And for the quarter, they received 230 million. And then there's straight line rent. It's just same as rent, just accounting things. And then they receive income from finance leases because they lend money to some hospitals too. They give them money. They lease out. They act as a banker. And the interest they receive on the money they lend out, 41 million. So that's a normal quarter. But the fourth quarter, they have negative 122 million of revenue. Because this is how much, like they have contracts with all these hospitals, like rental agreements. You can rent a facility for like $25,000 a month, and you sign a 5-year contract. So this is the rent they expect to receive based on all the rental agreements, all the contracts they have with their tenants, $336 million. That'll be a normal month. Kind of like in the fourth quarter of 2022, they received $380 million from all the contracts the tenants have with them. But Stewart screwed everything up in the fourth quarter of 2023. They had to pass through a huge loss, which sounds weird, like, but it's just it's an accounting loss. They didn't actually lose any money, but they will not get money from one of their tenants. That's why they're passing through a loss. Let's see what they said. So they footnote this column right here, the 336 million of rent. They footnote it. They say this reflects actual revenue except 458 million of reserves for billed rent, straight line rent, and interest income. So they took a $458 million haircut. Okay. This is definitely not straightforward. But this is helpful. This is helping me to remember better. So that's how much rent they expect for the whole quarter. Expect. And they had to take a big loss of $458.9 million. Net rent. So $336 million is what they expect to receive from their tenants, mostly from rent. They had to take a big loss from Steward because they have to show the loss sometime. They can't just hide it. I mean, they don't have to talk about it, but they have to mention it on their financials somewhere. So they did in the fourth quarter. They took a big loss. Look, it's almost identical. 336,480 minus 458,900 is 122.4 million. Right here, 122.4 million. That's how they tied. Because Steward, they're taking a loss for pretty much, I don't know, maybe the next year or 2 years of payments for Steward. That ties exactly. You see the net rent, negative 122 million, negative 122 million. It matches the income statement. That's in the fourth quarter. Let's look at the third quarter. Did they take a haircut also in the third quarter? In the third quarter of 2023, it was just a regular quarter, $306 million of I think this chart will. Let me get their rent for the last. the last few quarters. So let's start like looking at it closer, like we're doing right here. Other companies. Okay. Let's see, 1Q23. $4,900. 2Q23. $4Q23. We're just looking at that one, right? But the thing is, I should have kept it open. But this quarter, I mean, this last quarter is when they finally passed through the loss on their equity investments. That was, I think, the first time they did that. Oh, they updated the fourth quarter. Oh, first quarter. I wonder what they did different. They took a huge impairment. So this is the revised fourth quarter income statement. Let's see the original first quarter. Well, it's similar, just the loss isn't as big. So in the original first quarter, they had a loss of 730 million. They revised that to a loss of 900 million. Okay. It's interesting. they've taken really big impairments for a long time. Okay, so this is the rent they reported in their income statement. So it wasn't even that bad. I mean, second and third quarter did drop quite a bit. But it wasn't terrible. It was the fourth quarter of 23, it was negative. And now it's even lower. So it dropped 35%. Yeah, I guess it would be hard to figure this out. I mean, the fourth quarter is obvious because of negative revenue, but before that, it would be hard to identify it, I guess. The Paycom stock I bought a couple months ago shot up from 160 to 210 after the earnings release. Nice. Are you gonna hold on? I have a hard time selling stock. When stock goes up, even though I know when a stock goes up, you should be more likely to sell it. And if stock goes down, you should be more likely to buy it. But it's hard to so this is MPW yield. So it's real high, almost 15% a few months ago. I mean, the analysts, I'm sure a lot of people bought the stock, like a lot of everyday people bought this stock when it was going down a ton. Like they saw it going down, so they thought it was a good deal. I mean, I probably would have thought that also, because I don't know if I would have been able to identify their biggest tenant was going bankrupt. But even if you shorted it, I mean, it didn't unless you got it, unless you timed it perfectly, like right here, and then it came down. But if you shorted it, you would have to wait a few months for it to come down a lot. Yeah. I mean, just looking at the revenue, I'm saying it would be hard to identify. Maybe if you dug deeper into other parts of their income statement, you might have been able to see a decline. But what I was saying earlier, they filed Chapter 11, which is just reorganization. I think like something like 10 or 20% of companies that file Chapter 11 file Chapter 7 within like a year or two. So some companies are just in really, really bad shape, and they do file Chapter 11 because they want to help the bankruptcy court to stay afloat. So, the bankruptcy judge will help you reorganize your debts so you can stay as an active entity. And most people want you to stay in business, even a company like Medical Properties Trust. They want Stewart to stay in business because it's hard to just find someone to take over their hospitals. It's not that probably wouldn't happen. So they really be out for a long time, they would be out a lot of money and probably couldn't recover from that. Yep. Paycom. Well, it's up 28% a week. So Paycom, it IPO'd in 2014. 2021, it was almost 550. So 550. This is a lot of stocks that really peaked in 2021. It came down a lot. It still wasn't cheap at any point. It was still over 100 at almost every point. That's good. Yeah, that's awesome. I love when that happens. So they reported good earnings, I guess, for the quarter. Revenue. Okay, so they beat top and bottom a little bit. They probably had really good guidance for the rest of the fourth quarter and for 2025, since it went up so much. Why shares soared? Okay, it beat analyst expectations in the third quarter and raised guidance for the rest of 2024. That'll do it. Perhaps more importantly, the company's automated offerings continue to gain traction, recording its best ever sales quarter in September. Paycom's return to double-digit growth could have some legs. Looks good, yeah. Okay, I thought it was going to be a quick stream. It turned out to be an hour and 20 minutes. Yeah, I hope you learned something new. I'm trying to get to 40,000 subs. It's taken a long time. So please subscribe. Just subscribe, and then once I hit 40,000, you can unsubscribe. But just subscribe now so I get close to the 40,000. Okay, I'm doing a stream tomorrow with Victor. So I hope I see you there tomorrow. Thanks. Okay, talk to you later.